All right, here we go. We are on number 4. The fourth thing that I wish I could tell everybody that's getting ready to retire. Here it is. You know that 401k you've got? That wonderful, wonderful tax shelter that you've used over the years to grow your money? And it's been awesome, right? You've put money in, tax, you haven't had to pay tax. You got tax deductions, money went in, the money grew, tax deferred. Maybe you got a company match. They're awesome for retirement, right? Okay, here's the problem though. Now that you're getting ready to retire, what you need to recognize is that incredible tax tool called the 401k. And I could also say 403b or 457, they're the same thing. But that awesome retirement tool becomes, from a tax perspective now, the absolute worst asset you can hold in retirement. It's like you go from the coolest thing there is to, oh my gosh, this is horrible when it comes to retirement. So why? Why do I say that? Well, I want you to think about what happens during retirement. Number one, you already know this probably, but every time you pull money out of your 401k or IRA during retirement for income, you pay tax on it. We all know that, right? But here's the problem. This is what they don't tell you. Number two, when you pull money out of those 401ks and IRAs and you're receiving Social Security, guess what? Odds are high that you're going to end up paying more tax in your Social Security because you took money out of your 401k or IRA. In other words, you get double taxed. Here's another little known thing they don't talk about. When you're pulling money out of your 401k or IRA, guess what? You may find yourself paying more tax on interest and dividends from your investment portfolio, your non-retirement investment portfolio. Or if you're getting rental income, you might pay more tax on that. Here's another one, and this happens a lot when you're in your 80s. Because think about it, with an IRA or 401k, it is the only investment there is, the only one that forces you to pull money out, a certain amount of money out every year once you've hit a certain age, currently age 73. So once you've hit 73, every year you got to pull money out whether you want to or not. And as you pull that money out, it gets to be a larger and larger amount every year. And you get into your 80s, that gets to be a really big number. Guess what? As you're pulling that money out, it's added to all your taxable income. Here's what they don't tell you. A lot of people end up going over what are called IRMA levels, which are the Medicare levels. And if you make too much income, you get to pay more premium for your Medicare. That sounds fun, right? Yeah, it could be a lot more premium, like 3 times even. And so here you are, you're in your 80s, these RMDs are coming in, and next thing you know, you're paying more for your Medicare because the IRS thinks you're rich, right? How's that? So you get hit there. And don't forget that's Medicare Part B. You also get hit on Medicare Part D, as in dog. So you get hit in 2 ways. And here's another thing they don't tell you. Let's say you're married. I'm married to Becky. Let's say I've got a big old 401k that I've done a great job saving like I was told. I save money and save money and save, just like I was supposed to. And I retire and I've got like all this money in this IRA or this 401k. And then I die. Who gets the money? Becky gets the money. She's my wife. She's my beneficiary. But here's what they don't tell you. Becky is now, as a widow, filing as a single taxpayer, not a married taxpayer. What they don't tell you is that when you're filing as a married couple, those are the best tax rates available in the tax code. But once I die, she gets all my IRA money, 401k money. Suddenly, she's a single taxpayer, which are some of the worst tax rates in the tax code. So suddenly, here she is suddenly going into a terrible tax environment because I died. And what do I give her for her financial security? Oh, I know. Let's give her a big old account where every dollar she pulls out is going to be taxed. And she's going to be taxed at higher rates because she's single. I mean, it makes no sense, right? So this wonderful thing called a 401k, this wonderful IRA, great while you're working, horrible after you're retired. What do you do about it? What's the answer? How do you fix it? Well, what you do, this is why Roth conversions are so powerful. Anybody can convert IRA or 401k to Roth IRA, any amount, anytime, any income level, doesn't matter. And it's important to take a look at that. You should be looking at what's the impact of holding this 401k or IRA in retirement from a tax perspective, and would you be significantly better off if you applied some type of conversion schedule? Maybe not all at once, maybe over time, but if you were to convert that IRA to a Roth IRA over time, would that benefit you? Would that benefit your surviving spouse? You got to be looking at this stuff, because if you don't, you might find yourself giving the IRS tens of thousands, hundreds of thousands of dollars. You don't have to. All because you didn't pay attention to the impact of your 401k on your taxes in retirement.